and welcome. You are tuning in at just the right time because we are talking about exchange traded funds or ETFs in the Indian mutual fund landscape. So exchange traded funds are basically a low cost scheme where you also do away with something called the risk of active fund management or the risk of fund manager choices and biases. Exchange traded funds or ETFs are basically mirror portfolios. They mirror a chosen index. Whatever is there in that established market index goes into the ETF. ETFs are listed on stock exchanges, so you can buy them like stocks. You need a Demat account as well. Now, if you're a first-time investor and you don't know very much about ETFs, before you jump into this low-cost, low-risk option, you must know some of the nuances which are very important. Without knowing them, you'd be doing yourself a disservice or you'd be putting yourself at a disadvantage by investing in ETFs. So what are these things? Well, the first thing is the cost, right? Like we said, ETF mirrors the portfolio of an index. And in the Indian context, ETFs are still a very small subset. So there are a lot many more active funds which are out there. And within the ETF subset, equity schemes are what dominate. There are, very few, one or two debt mutual fund ETFs. Now, in this equity space, if you have two schemes, for example, which mirror the Nifty 50 index, the thing is that the cost may or may not be the same. It's not standardized. The cost of these schemes, although they are low risk, low cost, and is not standardized. For example, ETFs which mirror the Nifty 50, the cost can range from anywhere between 0.05% or 5 paisa to 0.15% or 15 paisa. And that's a difference of 3 times, right? It doesn't seem like a lot if you're only investing for a year or a few months or even 2 or 3 years. But over a 10-15 year period, that difference can be quite a lot. So you want to make sure that you're picking an ETF where the cost is actually on the lower side and not one of the most expensive ETFs for that underlying index. The other thing that you need to keep a watch on is the underlying index itself. So like I said, most of the ETFs in the Indian mutual fund landscape are equity based, and within that based on the market benchmarks Nifty 50 and Sensex 30. But there are a few which are based on sort of mid-cap or the next level, not even mid-cap, but the next level of stocks like the Nifty Next 50 or the Nifty 100. And there are smart beta ETFs available as well. But if you are again a new investor, it's best to start out with the large cap ETFs so that you get a sense of the risk return dynamics of this product. You get a sense of how to buy, how to sell, because they are slightly different from actively managed funds. And also, while the layer of smart beta ETFs could be high, they are new, relatively new, and there is no empirical evidence that says that this smart beta strategy can, beat a plain vanilla ETF in a period of 10 to 15 years. And if you really want to do away with the active fund management risk, then taking on smart beta is adding that, one level of risk because you've put those filters in a smart beta ETF. So stick to the plain vanilla Nifty 50 ETF or a Sensex ETF and then see whether you want to scale it up to the next level. The last thing, and this is the most important thing, is the volume. Now, remember I said that ETFs are listed on stock exchanges and hence they're traded like stocks. If you're a stock trader, you know that the volume of a stock on a particular day actually matters to its price discovery. This is even more relevant in an ETF because there is a published NAV and there is a traded price. So there are two different things here and they should ideally match at the end of the day. And where there is low volume, this doesn't match. There can also be an arbitrage between the two exchanges, BSE and NSE price of that ETF. Let me give you an example. In today's trade, the UTI Nifty 50 ETF had just 61 units traded. Okay, that's very low volume, of course. Compare that to the Nippon Nifty Bs, which had around 45,000 units traded. So that's, relatively much better volume. What also happens on the price discovery front is that there was a big difference for the UTI Nifty ETF between the NSE price and the BSE price for the day. Also, the closing price for the previous day was different from the closing NAV of the previous day by 10 rupees. So there was a 10 rupees difference in the closing price versus the closing NAV of the scheme. The NAV is published by the mutual fund house, and the price is what the ETF is traded on exchanges and what comes out at the end of the day thanks to that trading. So there's a 10 rupee difference. So you can imagine that this will cause some trouble if you are going to be buying and selling. And with 61 units traded, that's very, very low volume. On the other hand, the Nippon Nifty Bs, which is also an ETF that tracks the Nifty 50, there was no price arbitrage between NSE and BSE, and even in the closing price of the previous day versus the closing NAV of the previous day, there was practically no difference. I think 2 paisa, that's it. So these are important findings in ETFs, and you should be aware of the average volume of the ETF that you are investing into. Mutual fund houses have found a way around this volume and price discovery issue. They have something called index funds, which also track the movement of an underlying index, except they are in the mutual fund format. They are not listed on stock exchanges. You cannot buy and sell them. You get the daily NAV just like you would for any other mutual fund scheme. So that takes away this whole arbitrage of price, which you may not want to take on at this point. They are slightly more expensive than ETFs, but nevertheless, that is an option that you can choose if you want to stay away from fund manager risk, and they do come at a lower cost as compared to actively managed mutual fund schemes. Now you know all the advantages and the disadvantages of investing in ETFs. So do make that choice with this knowledge, whether you want to go ahead and start investing in your mutual fund ETF scheme.